Welcome back to the deep dive. I'm genuinely excited today
Up to it.
because we're about to dive into something that often feels, well, pretty complex.
Right. Gift tax and charitable donation.
Exactly. Our mission today. Let's unpack these rules. We want to help you understand how your generosity during your lifetime and your legacy planning connects with the tax code. Make it clear, make it useful.
And look, this isn't just about ticking boxes for the IRS. It's really about empowering you so you can make the most of your financial goals, make the impact you want to make,
hmm
whether that's helping out family or supporting causes you believe in. Understanding this stuff is key.
Absolutely. And we're working from this stack of materials you provided, aiming to make it super accessible.
Let's do it.
Okay, so to really get the big picture, let's start with the basics. The foundations of gift tax.
Right, because it's all connected.
In the U.S., we have the federal gift tax that's for gifts you make while you're alive, and the estate tax for transfers when you pass away. And they're not separate things, are they?
No, not at all. They're woven together in what's called a unified transfer tax system.
Unified, okay.
Yeah, the crucial point is it looks at your cumulative taxable transfers. Everything over your lifetime, plus what's transferred at death.
So it all adds up.
It all adds up. But here's the good news, and it's significant good news. There's a very large unified credit, sometimes called the applicable credit.
A credit against the tax.
Exactly. For 2023, that credit effectively shields $12,920,000.
12.92 million. Wow.
Yes, that's the total amount you can transfer
Yeah.
cumulatively over your life and at death without actually paying federal gift or estate tax.
Okay, that's a huge number. So for a lot of people, maybe they won't owe federal gift or estate tax.
For many people, that's absolutely right. But, for planning purposes and for those with very substantial assets, you still need to understand what actually counts as a gift in this system.
Right. It's not just like a birthday present you wrap up.
Precisely. The IRS definition is broad. It's any transfer of money or property, real estate, personal stuff, tangible, intangible.
So pretty much anything of value.
Anything of value, yeah. Transferred for less than adequate or full consideration.
Adequate or full consideration, meaning
Meaning, if you give something away and don't get something of basically equal fair market value back in return, the IRS sees that difference as a gift, and the gift tax rules might apply.
got it. Okay, so now let's talk about ways to make gifts without triggering tax implications immediately. The exclusions.
Yes, these are really powerful tools. First up, the annual exclusion.
This is the one people hear about most often, right?
It is. It lets you give up to a certain amount per person each year, completely tax-free. For 2023, that amount is $17,000.
$17,000 to anyone.
To any individual donor, yes.
Yeah.
You could give 17K to your daughter, 17K to your son, 17K to your neighbor, all in the same year.
And none of that counts as a taxable gift.
Correct. It doesn't use up any of that big lifetime unified credit we just talked about either. It's just off the radar for tax purposes year after year.
That's amazing. And if you're married,
Well, then it gets even better. Married couples can elect to gift split.
split the gift.
Effectively, yes.
Yeah.
It doubles the annual exclusion. So a couple can give up to $34,000 per dunny per year, tax-free.
34,000, that's substantial.
It really is. Think about doing that consistently over many years for several people, children, grandchildren. You're talking about moving significant wealth out of your potential taxable estate without incurring any gift tax.
That's real legacy planning, serious impact over time.
Definitely. Now, beyond that annual exclusion, there are also some really important unlimited exclusions.
Unlimited. Okay, these sound powerful.
They are, for specific situations. First, education. If you pay tuition directly to an educational institution, a college, a private school for someone else.
Like for a grandchild.
Exactly. That payment is completely excluded from gift tax. No limit.
The key is directly.
Directly is the absolute key. You
Yeah.
can't give the money to the student to pay tuition. You have to pay the school itself.
Okay. What else is unlimited?
Medical care.
Ah.
Similar rule. If you pay medical expenses directly to the healthcare provider, the hospital, the doctor, for someone else's care.
Again, directly to the provider.
Directly to the provider.
Yeah.
That's also an unlimited exclusion. No gift tax implications.
Got it. Direct payments for tuition and medical, that covers some major life expenses.
It does. And we'll get into charitable gifts more later, but they also generally have an unlimited exclusion.
Okay.
But here's one that's huge for family planning. The marital deduction.
Transfers between spouses.
Yes, generally transfers of property between spouses are allowed an unlimited exclusion from gift tax. You can give your spouse as much as you want, whenever you want, typically without any gift tax consequences.
Unlimited. That sounds straightforward, but are there catches? You mentioned terminable interests.
Right. So to get that unlimited marital deduction, the gift usually can't be what's called a terminable interest, meaning an interest that might end or fail based on time passing or an event occurring.
Like giving income for only 10 years?
Sort of, yeah. But there's a major exception called qualified terminable interest property, or QTIP.
QTIP. Okay, what's that about? Sounds technical.
It is a bit, but it's a really important planning tool, especially in blended families. QTIP is typically a trust. It lets you provide for your surviving spouse for their entire lifetime.
So they get the benefit while they're alive.
Exactly. They usually have to get all the income paid at least annually. And crucially, no one else can get distributions from that trust while the surviving spouse is alive.
Okay.
But the key feature is you, the person setting up the trust, get to decide where the property goes after your surviving spouse passes away.
Ah, so you ensure it ultimately goes to, say, your kids from a prior marriage.
Precisely. It provides for the spouse but controls the final destination. There are strict rules. The spouse needs the right to make the property productive. It gets taxed in their estate later, so it definitely requires careful drafting by an attorney.
That makes sense. Let's see how this marital status thing plays out with an example. Casey and Pat. They get engaged in April. Casey gives Pat a ring worth $50,000.
Okay? Engaged, not married yet.
Right. Then they get married in July. After the wedding, Casey gives Pat $75,000 cash. What are the gift tax implications here?
This is a perfect illustration of timing. That $75,000 cash gift after the wedding,
Yes.
it fully qualifies for the unlimited marital deduction because they were spouses when the transfer happened. So zero taxable gift for that $75K.
Okay. But the ring, given before the wedding.
Yeah, the $50,000 ring. Since they weren't married yet, no unlimited marital deduction is available for that gift.
So it's a taxable gift.
Potentially. It's eligible for the annual exclusion, so Casey can use the $17,000 annual exclusion against the $50,000 ring.
Meaning $50,000 minus $17,000.
Leaves $33,000.
Yeah.
That $33,000 is a taxable gift for Casey in year one. It doesn't necessarily mean Casey pays tax, but it uses up $33,000 of that big lifetime unified credit amount.
Wow. So just a few months difference completely changes the tax treatment because of the marital status?
Exactly. Timing is everything with the marital deduction.
Fascinating. Okay, so we know what a gift is, we know about exclusions, but the type of gift matters too, right? When someone actually gets to use or enjoy it.
Absolutely. This brings us to the distinction between present interests and future interests.
Present versus future, what's the core difference?
A future interest basically means the recipient's right to actually use, possess, or enjoy the property is delayed somehow. It's not immediate.
Okay, their enjoyment is pushed off to the future. Why does this matter so much?
It matters immensely because only gifts of a present interest qualify for that $17,000 annual exclusion we talked about.
Ah, so if it's a future interest gift,
Then generally you have to file a gift tax return reporting it, even if the value is less than $17,000. The annual exclusion doesn't apply.
that's a huge deal. So what kind of gifts are typically considered future interests? Give us some examples.
Sure. A common one is a remainder interest. Like you give property to someone for their life, and then after they die, it goes to someone else. That someone else has a future interest.
Because they have to wait.
They have to wait. Reversions can be another where the property might come back to you, the donor, under certain conditions. Also, certain types of trusts where the trustee has to accumulate the income or has total discretion on whether to pay it out or not can create future interests for the beneficiaries.
Okay, so if the benefit isn't immediate and unrestricted, watch out. What about present interests then? The ones that do qualify for the exclusion.
Those are usually more straightforward. An outright gift of cash or property you handed over, they own it immediately. That's a present interest.
Makes sense.
Also, if a trust requires the trustee to distribute income at least annually, that income interest is typically a present interest. A life estate, the right to use property for your lifetime is generally a present interest. Even things like bonds, notes, or unrestricted gifts of life insurance policies usually count.
So immediate access or benefit is key for that annual exclusion.
That's the main takeaway.
Now, another layer. Complete versus incomplete gifts. When does the gift officially happen for tax purposes?
Right. Because only complete gifts are actually subject to the gift tax and, again, potentially eligible for the annual exclusion.
So what makes a gift complete?
Generally, a gift is complete when the donor has given up dominion and control and doesn't have the power to change its disposition. Interestingly, it can be complete even if the recipient isn't born yet, as long as their identity is ascertainable later.
Like a gift and trust for future grandchildren.
Exactly. And it can still be complete even if there's a possibility, however remote, that the property might come back to the donor someday.
So what makes a gift incomplete then?
Two main categories: conditional gifts and revocable gifts.
Conditional, like,
Like, I'll give you this $20,000 if you graduate from college. The gift isn't complete and therefore not subject to gift tax yet until the condition is actually met.
so until graduation day in that example.
Right. And revocable means the donor keeps the power to take the gift back or change who gets it.
Like setting up a revocable living trust.
That's a classic example. When you transfer assets to your own revocable living trust, it's usually not a completed gift because you retain the power to revoke it or change beneficiaries. The gift only becomes complete if and when you give up those rights, or maybe upon your death, depending on the terms.
Okay, that distinction is important for trust planning. Now, a practical question. Who actually pays the gift tax if it's owed?
Good question, because there's a common misconception. The donor, the person making the gift, is the one legally obligated to pay any gift tax due.
Not the recipient.
No, the recipient, the don, pays zero gift tax. And importantly, the gift is not considered taxable income to the recipient either.
That's good news for the person getting the gift. What about their basis in the property if they sell it later?
Ah, basis, yes. Generally, for gifted property, the recipient takes the donor's original basis. It's called carryover basis.
So whatever the donor paid for it, essentially.
Plus, potentially an adjustment for any gift tax paid on the appreciation. This is important because it affects the capital gain the recipient will pay if they eventually sell the property.
Got it. Carryover basis for gifts. We'll compare that to inherited property later. Okay, so we have all these rules, exclusions, present, future, complete, incomplete. How do we actually calculate the taxable gifts for a given year?
Okay, let's put it together. You start with the fair market value of all the gifts you made during the year.
Fair market value at the time of the gift.
Correct. Then you subtract any applicable exclusions, primarily that $17,000 annual exclusion per ton, or $34,000 if gift splitting applies.
Yeah.
You also subtract any deductions, like the unlimited marital deduction or the charitable deduction for qualifying gifts.
Right.
What's left after those subtractions is your total taxable gifts for the year.
So what does this all mean in practice? Let's use an example. Jack Smith, single taxpayer, 2023.
Okay.
He gives $20,000 cash to Adele, a $4,000 sculpture to Barry, and $40,000 worth of Zorro Corp stock to Christine.
Okay, 3 gifts.
Yeah.
Let's take them one by one for Jack, who is single. First, Adele, $20,000 cash.
That's over the $17,000 annual exclusion.
Right. So $20,000 minus the $17,000 exclusion means a $3,000 taxable gift to Adele.
Okay. Next, Barry, $4,000 sculpture.
That's under the $17,000 exclusion.
So zero taxable gift there.
Correct. Fully excluded.
Then finally, Christine, $40,000 in stock.
Okay, that's well over the exclusion. So $40,000 minus the $17,000 exclusion leaves
$23,000.
$23,000 taxable gift to Christine.
So Jack's total taxable gifts for the year are $3,000 plus $0 plus $23,000, which is $26,000.
Exactly, $26,000 in total taxable buffer.
Hmm.
But he does need to file a gift tax return, Form 709.
Why, if he doesn't owe tax?
Because any gift to a single person that exceeds the annual exclusion amount, $17,000 in this case, generally requires filing a return, even when no tax is due. Also, gift splitting always requires filing a return.
Ah, okay. Filing is required to report the taxable gift and track the use of the lifetime credit.
Precisely. Now let's change one fact. What if Jack is married and he and his spouse elect to gift split?
Okay, so now they can combine their annual exclusions. That's $34,000 per done.
Right. How does that change the calculation? Let's look at Adele's $20,000 gift again.
Well, $20,000 is now less than the $34,000 exclusion available through gift splitting.
So the taxable gift to Adele becomes
Zero.
zero. Okay, Barry's $4,000 gift.
Still zero, easily covered.
Right. And Christine's $40,000 stock gift.
Okay, $40,000 minus the $34,000 exclusion leaves only $6,000 as a taxable gift.
Exactly. So now Jack's total taxable gifts for the year with gift splitting are $0 plus $0 plus $6,000.
Just $6,000, down from $26,000 when he was single.
A huge difference. It
Yep.
really shows the power of gift splitting for married couples to transfer wealth efficiently.
Absolutely. Okay, one more example to nail down those unlimited exclusions. Let's talk about Jill, single taxpayer.
Good, Jill.
In 1 year, she gives away $100,000 in total. Let's break it down.
All right.
$20,000 to a library building fund. That's a public charity.
Okay, charitable gift.
$20,000 paid directly to City Community College for her granddaughter Izzy's tuition.
Direct tuition payment. Got it.
$20,000 paid directly to City Hospital for her friend Jack's surgery.
Direct medical payment. Okay.
Then $20,000 cash given to Izzy for her general living expenses.
Okay, gift to Izzy directly.
And finally, $20,000 cash given to Jack for his home care expenses after the surgery.
Gift to Jack directly. Okay, 5 gifts, $20K each.
Right. How much are Jill's taxable gifts?
Okay, let's use the rules. First, the $20,000 to the library fund.
Charitable donation to a public charity.
That qualifies for the unlimited charitable deduction. So 0 taxable gift there.
Okay, one down. Next, the $20,000 direct tuition payment to the college for Izzy.
That's the unlimited exclusion for direct educational expense payments.
So 0 taxable gift again.
Correct. Next, the $20,000 direct medical payment to the hospital for Jack. Same logic, right? Unlimited exclusion for direct medical expense payments. Yep. 0 taxable gift there, too. So those first 3 gifts, totaling $60,000, are completely excluded.
Nice. What's left?
The $20,000 cash to Izzy for living expenses and the $20,000 cash to Jack for home care.
Okay, these are just regular gifts to individuals. They don't qualify for those unlimited exclusions.
So they are potentially taxable gifts.
Yes, but they do qualify for the regular $17,000 annual exclusion each.
Ah, okay. So for Izzy, it's $20,000 minus the $17,000 exclusion.
The $3,000 taxable gift.
And same for Jack, $20,000 minus the $17,000 exclusion.
Another $3,000 taxable gift.
So Jill's total taxable gifts for the year are $3,000 plus $3,000.
Just $6,000, even though she gave away $100,000 in total.
That really highlights how important understanding those specific unlimited exclusions is.
Absolutely. So just to quickly recap the keys for the annual exclusion.
Yeah.
The gift must be a present interest, it has to be complete, and it needs to be under that annual limit, $17K or $34K. Unless one of those special unlimited exclusions applies direct medical, direct tuition, charitable, or marital.
Got it. And the overall tax calculation involves summing up current taxable gifts, adding past taxable gifts, figuring the tax on that cumulative amount, and then applying credits for past taxes paid, and, critically, that big lifetime applicable credit.
That's the basic flow, yes.
Okay, moving into Section 3. Let's talk strategy. Gifting during your lifetime versus letting assets pass through your estate at death. What's the advantage of lifetime gifting?
Well, what's fascinating here, strategically speaking, is leveraging that annual gift tax exclusion, the $17K or $34K per person.
Because
That exclusion only exists for lifetime gifts. You cannot apply a $17,000 per beneficiary exclusion to assets transferred via your will or trust at death.
so it's a use it or lose it kind of benefit each year.
Exactly. If you have a sizable estate that might be subject to estate tax down the road, making those annual exclusion gifts every year is an incredibly effective way to reduce the size of your taxable estate over time, completely tax-free.
That makes perfect sense. Use the annual exclusion while you can. Now, another critical factor, basis. This affects the income tax the recipient pays later, right?
Hugely important. Basis is essentially your cost in an asset for tax purposes. And the basis rules are very different for assets received as a gift versus assets received as an inheritance.
Okay, let's break that down. What's the rule for gifted property again?
For gifted property, as we touched on, the recipient generally gets the donor's basis. We call this carryover basis.
So if I bought stock for $10 and gift it to my child when it's worth $50K, their basis is still my original $10.
Generally, yes,
Yeah.
with potential minor adjustments for gift tax paid. So if your child later sells that stock for, say, $60, they'd have a $50K capital gain, $60K selling price minus $10 basis.
Okay, so the gain that built up while I owned it is deferred until they sell.
Right. And a key benefit of gifting appreciated property is that any future appreciation after the day of the gift escapes the gift and estate tax system entirely for you, the donor.
Okay, that's carryover basis for gifts. What about property someone inherits at death?
This is where it gets really interesting and often advantageous from an income tax perspective.
Yeah.
For inherited property, the recipient's basis is typically the fair market value of the asset at the date of the original owner's death.
Not the original cost.
No, the value on the day of death. This is often called a step up in basis if the asset has appreciated.
Step up. Okay, so using my stock example, I bought it for $10. It's worth $50 when I pass away, and my child inherits it. Their basis is...
Their basis is stepped up to $50,000.
Wow. So if they immediately sell it for $50,000...
They have zero capital gain, 50K selling price minus $50 stepped up basis.
So all that appreciation that happened during my lifetime just disappears for income tax purposes.
Exactly. That appreciation is never subject to capital gains tax for the heir. That's a massive tax benefit associated with inheriting appreciated assets.
Okay, this creates a real planning dilemma then.
It really does. This raises an important question. Do you gift appreciated assets during your lifetime, using the annual exclusion perhaps, but saddling the recipient with your low carryover basis and a future capital gains tax bill?
Right.
Or do you hold on to those appreciated assets until death, potentially paying estate tax on them if your estate is large enough, but giving your heirs the benefit of that step up in basis, wiping out the capital gains tax liability on all the appreciation up to your death?
That's a fundamental trade-off. Balancing potential gift state tax savings now versus potential income tax savings for the heirs later.
It's a core strategic decision in estate planning. You have to weigh the numbers, consider the types of assets, the potential growth, the tax brackets involved.
Yeah.
It's complex.
Definitely something to think carefully about. Okay, let's shift gears to Section 4, charitable contributions, giving back with potential tax benefit.
Yes, a way to align your generosity with tax planning.
First off, who qualifies? Can you just donate to any cause and get a deduction?
Not quite. To get a tax deduction for your donation, the recipient organization generally needs to be recognized by the IRS as a Section 501c3 organization.
501c3, that's the standard classification.
Yes, that includes most public charities like churches, schools, hospitals, museums, and also private foundations. You can usually check an organization's status on the IRS website.
Okay. Now, donating cash is pretty straightforward, but what about donating property like stocks, art, furniture?
Right. Donating non-cash property has more complex rules, and the deduction amount depends on the type of property.
Okay, what are the main categories?
Broadly, we distinguish between ordinary income property and long-term capital gain property.
Ordinary income property, what falls into that bucket?
Things like inventory from a business, assets you've held for 1 year or less, short-term capital assets, investment or personal use property that has decreased in value since you acquired it, and certain depreciation recapture amounts.
Okay, and if you donate that type of property?
Your deduction is limited to the lesser of the property's fair market value or its adjusted basis, usually your cost.
So if it's gone down in value, you only deduct the lower current value.
Correct. You don't get a deduction for the loss in value through a charitable gift.
Got it. What about the other category, long-term capital gain property?
This is typically appreciated property like stocks, bonds, real estate collectibles that you've held for more than 1 year.
And if you donate this appreciated long-term property...
Here's the big benefit. Generally, your deduction is equal to the property's full fair market value at the time of the contribution.
Even if your basis, your cost, was much lower.
Yes. So you get a deduction for the current higher value, and you avoid paying capital gains tax on the appreciation yourself. It's often the most tax-efficient way to make a large charitable gift.
That sounds like a very powerful incentive to donate appreciated assets held long-term.
It absolutely is. But, as always, there are some important nuances.
Okay, like what?
One key consideration is for donations of tangible personal property that's long-term capital gain property. Think artwork, antiques, jewelry.
Oh.
If the charity's use of that donated item is unrelated to its tax-exempt purpose.
Unrelated use, meaning...
Meaning, for example, if you donate a valuable painting to a hospital and the hospital immediately sells it instead of displaying it for patients or staff to appreciate, selling it is likely unrelated to the hospital's core charitable mission.
And if it's an unrelated use...
Then your deduction is limited to your adjusted basis in the property, not the higher fair market value.
Ouch. So you lose that big benefit of deducting the full appreciated value.
Exactly. It's critical to understand how the charity intends to use the specific tangible property you're donating if you want to maximize your deduction.
That's a really important detail. What about vehicles? Cars, boats?
Oh, yes. Vehicle donations have their own special, quite specific rules. Generally, if you donate a qualified vehicle, car, truck, boat, airplane worth more than $500, and the charity sells it without making significant use of it or improving it first, your deduction is limited to the lesser of the gross proceeds the charity gets from the sale or the fair market value on the date you donated it.
So you're capped by what they actually sell it for, in many cases.
Often, yes. If they sell it for $500 or less, your deduction is generally capped at the lesser of $500 or the fair market value. There are exceptions if the charity uses the vehicle significantly or makes material improvements, but the sale proceeds rule is common.
Okay, good to know. Let's use an example to solidify these property donation rules. Bill Sanders and his painting.
Okay, Beale's painting.
He bought it 5 years ago for $25,000. A museum, a qualified charity, wants it for its collection. Scenario 1. The painting's current fair market value, FMV, is only $20,000.
Okay, so it's depreciated. Cost 25K, FMV 20K. He's held it long term.
What's his deduction?
Because it has decreased in value, it falls under the rule similar to ordinary income property for deduction limits. His deduction is the lesser of his $25,000 basis or the $20,000 FMV.
So he only gets a $20,000 deduction.
Correct.
Okay. Scenario 2. Same painting, same $25,000 cost, held 5 years, but now its FMV is $30,000. It's appreciated.
All right, now it's appreciated long-term capital gain property. Held more than a year, FMV, $30 is higher than basis, 25K.
So, assuming the museum will use it in its collection, a related use,
Then Bill's deduction is generally the full fair market value at the time of the gift.
which is $30,000.
$30,000 deduction.
Yeah.
He also avoids paying capital gains tax on that $5,000 appreciation.
Nice benefit. But connect this to the bigger picture. What if the museum, even though it's an art museum, immediately turns around and sells the painting?
Ah, that's the critical unrelated use test for tangible personal property. If
Yeah.
they sell it, that's generally considered an unrelated use.
And then,
Then Bill's deduction will be limited to his adjusted basis in the painting, which was $25,000.
even though it was worth $30,000.
Yes, he'd lose out on deducting that $5,000 of appreciation because of the unrelated use.
Yeah.
It underscores why confirming the charity's intended use is so vital for these types of donations.
Huge difference. Okay, finally, Section 5. Let's talk about maximizing the deduction you can actually take in a given year. AGI limits and logistics.
Right, because even if you calculate a potential deduction based on the property rules, there are limits based on your income.
AGI adjusted gross income.
Exactly. The maximum amount you can deduct for charitable contributions in any one year is capped as a percentage of your AGI, and the percentage depends on both the type of property donated and the type of charity.
Okay, break down those percentages.
For contributions to public charities, private operating foundations, and certain other foundations.
The most common types people donate to.
Generally, yes. For cash contributions, the limit is typically 60% of your AGI.
60%. Okay.
For donations of ordinary income property, and that depreciated painting we discussed, the limit is generally 50% of your AGI.
50% for ordinary income property.
And for donations of long-term capital gain property, like that appreciated painting, assuming related use, the limit is generally 30% of your AGI.
30% for LTCG properties, so 60, 50, 30. Are those limits lower for donations to, say, private non-operating foundations?
Yes, the limits are typically lower for contributions to private non-operating foundations, often 30% for cash and ordinary income property and 20% for LTCG property. It's important to know the status of the charity.
And what if you make multiple types of donations in one year? Cash, ordinary property, LTCG property. How do these limits interact? Is there an order?
Yes, there's a specific order of application which is crucial. First, you apply the limit to your cash contributions, subject to the 60% AGI ceiling.
Cash first, up to 60%.
Then you look at your ordinary income property contributions, applying the 50% AGI limit. But this limit is reduced by the amount of cash contributions allowed under the 60% limit.
Okay, so the 50% overall bucket includes the cash already deducted.
Sort of. It gets a bit complex, but think of it sequentially. Finally, you apply the limit to your long-term capital gain property contributions, which are generally subject to the 30% AGI limit. But again, there are interactions with the amounts deducted under the 50%, 60% categories. The total deduction across all types generally can't exceed 50% or 60% of AGI, depending on the mix.
It sounds like you really need to calculate it step by step in the right order.
Absolutely. Order matters.
What happens if your donation exceeds these AGI limits in a particular year? Do you just lose the excess deduction?
Thankfully, no, not usually. There's a valuable carryover rule. Excess contributions that you can't deduct in the current year due to AGI limits can generally be carried forward and deducted over the next 5 years.
5-year carryover, that's helpful.
Yes, subject to the same AGI limits in those future years. It's applied on a first-in, first-out basis.
Okay, and logistics, what kind of proof do you need?
Record keeping is key. For any cash contribution, you need proof, like a bank record or written statement from the charity. For non-cash contributions over $500, you generally need to file Form 8283 with your tax return.
Form 8283 for non-cash over $500. What about larger non-cash gifts?
For donations of items or groups of similar items valued at more than $5,000, you usually need a qualified written appraisal.
An appraisal, that sounds like a hurdle.
It can be, but it's required to substantiate the value. There's a key exception, though. Publicly traded securities don't require an appraisal because their value is readily available from market quotes.
Okay, that's a useful exception. All right, let's pull this all together with a comprehensive example. Joe Kelly.
Okay, Joe Kelly's contributions. Let's unpack this carefully.
Joe's adjusted gross income, AGI, is $100,000.
AGI, $100K.
Got it. He makes 3 contributions, all to public charities.
Okay.
1, $15,000 cash to the United Way.
$15K cash, public charity.
2, used personal furniture to Goodwill. He bought it 3 years ago for $25,000, but its current fair market value is only $10,000.
Okay, furniture, base is $25K, FMD $10, held 1 year. Depreciated personal property.
3, a sculpture to an art museum. He bought it 5 years ago for $20,000. Its current FMV is $30,000. Assume the museum will display it, related use.
Sculpture, base is $20K, FMV $30K, held 1 year. Appreciated LTCG property, related use. Okay, let's calculate his deduction, applying the AGI limits in order.
Right. AGI is $100,000. First, the cash.
Cash, $15,000 to United Way Public Charity. The limit for cash to public charities is 60% of AGI.
60% of $100,000 is $60,000.
Right. His $15,000 cash gift is well below that $60,000 limit, so he can deduct the full $15,000 cash contribution.
Okay, a $15,000 deducted so far. Next, the furniture.
The furniture. FMV $10,000, basis $25,000. Since FMV is less than basis, the potential deduction is limited to the FMV of $10,000. This type of property falls under the 50% AGI limit category.
50% of $100,000 is $50,000.
Right. Now, this overall 50% limit space has to accommodate both the ordinary income property and the cash. He's already used $15,000 for cash. Does his $10,000 furniture donation fit within the remaining $50,000 overall ceiling?
Yes, $15,000 cash plus $10,000 furniture, which is less than $50,000.
Correct. So he can deduct the full $10,000 for the furniture.
Okay, so now he's deducted $15,000 cash plus $10,000 furniture, $25,000 total so far. Finally, the sculpture.
The sculpture. FMV, $30,000, basis $20,000. Appreciated LTCG property related use. The potential deduction is the $30,000 FMV. This falls under the 30% AGI limit category.
30% of $100,000 is $30,000.
Right. So the potential deduction is $30,000, and the specific limit for LTCG property is also $30,000.
Yeah.
Looks good. Right.
Seems like it.
But wait. There's an overall limit, too. The total deduction for all contributions to public charities generally can't exceed 50% of AGI when you have a mix like this, or 60% if it was all cash.
Ah, the overall 50% ceiling, which is $50,000 for Joe.
Right. He's already deducted $25,000, $15K cash plus $10K furniture. How much room is left under that $50,000 overall cap?
$50,000 minus $25,000 leaves $25,000 of room.
Exactly. So even though the sculpture's potential deduction is $30,000,
right,
and it fits under the specific 30% AGI limit, $30K, he's limited by the overall 50% AGI ceiling. He can only deduct $25,000 for the sculpture this year.
Okay, so the LTCG deduction gets squeezed by the overall limit in this case.
Precisely. So let's add up Joe's total allowable deduction for the year.
$15,000 for cash.
Plus $10,000 for the furniture, ordinary income property.
Plus $25,000 for the sculpture, LTCG property.
Which totals $50,000.
$50,000 is his total charitable deduction for the year.
Correct. Which makes sense as it hits that overall 50% AGI limit, $50K on $100K AGI.
What happens to the part of the sculpture's value he couldn't deduct? He donated $30,000 worth, but only deducted $25,000.
That's where the carryover comes in. The difference, $30,000 minus $25,000, it's just $5,000.
Yes.
That $5,000 becomes a charitable contribution carry forward. It retains its character as an LTCG property contribution.
So he can potentially deduct that $5,000 in the next year.
Yes, or over the next 5 years, subject to the AGI limits in those future years.
Wow. That example really shows how all the pieces fit together. Property types, specific limits, overall limits, and carryovers. You need to follow the steps carefully.
You really do. But understanding it allows for much smarter charitable planning.
Absolutely. Okay, that was a truly comprehensive deep dive. We covered a lot of ground, from unified credits to QTIPs to basis step up to AGI limits.
We did.
So what does this all mean for you, the listener? I think the bottom line is that understanding these rules, really getting how gift tax and charitable donations work, empowers you.
Definitely.
It lets you make informed choices about your wealth, about the legacy you want to leave, and about the impact you want to make through your giving. It's not just about taxes, it's about thoughtful, strategic planning.
And maybe this raises an important question for you to think about.
Hmm.
How might a deeper understanding of these concepts, these tools you've discussed, allow you to not only better secure your own financial future and that of your family,
Hmm.
but also to more effectively shape the future you wish to see in the world through your charitable giving? How can you leverage these rules for greater impact?
That's a great thought to leave people with. We definitely encourage you to review your own financial plans, your estate plans, your charitable goals in light of what we've discussed today.
It's worth the time.
This deep dive is really just a starting point. There's always more to explore and how these complex rules can work for you. Until next time, keep exploring, keep learning, and keep making an impact.